Hello and welcome to today's episode of Nucleus Investment Insights. Today's episode is called The Great Insolvency Façade. Today we're joined by Caroline Di Russo. Caroline's a lawyer with 15 years of experience in commercial litigation and corporate insolvency. She's also a regular contributor to Sky News and has her own company and brand called the Daily Luxe. Caroline, welcome.
Hi guys, nice to be back.
It's a pleasure to have you on the show again. It has been a couple of years. I think we're getting a bit of a...
It has been, but at least we've got plenty to look back on that base.
Yeah, I mean, last time it was just audio. We are in the modern era. We've got video and audio, but it sounds like we've got a bit of a lag, so we'll just do our best to work with that. As always, we have Damien Klassen, who's Nucleus Wealth's co-founder and chief investment officer. Damo, welcome.
Thanks, Sam.
My name's Sam Kerr, and I'm the senior financial advisor at Nucleus Wealth. On the agenda today, we'll explore whether insolvency levels are artificially lower after the huge financial stimulus from COVID, or whether this is the new normal. We'll look at business insolvency, construction insolvency, in particular, and personal insolvency levels. Then we'll talk about the luxury goods market, and as always, at the end, we'll discuss the investment implications. Just a quick housekeeping reminder: if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. We are live every Thursday at 12:30 Sydney, Melbourne time. So just jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do the best to answer them during the show. You can also follow us on your preferred podcast platform, as our show's available on all the majors. And if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view those at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way, Damo, I'll pass it over to you to give us a bit of context and get the ball rolling.
Yeah, thanks, Sam. So, look, we're great to have you back, Caroline. And given that there is a little bit of a lag, I might sort of ask you a few questions and let you monologue for a little bit before sort of coming back. What I thought I'd do just first is set the scene for, I guess, what I'm seeing in the business insolvencies, because there's a few weird things going on, and then maybe after that we can sort of talk through what that is. And so I'll start with just a graph of sort of, I've got like the 1 month business insolvencies, the 3 month average, and then a 12-month average, and just because the business insolvencies are a bit weird, and January levels are quite low, and then February levels are really high, and so it's sort of like a joining of the two almost every year. And so you can see from for anyone listening on the podcast, there's a pink line which is sort of this running 12-month average that sort of ran at about 750 per month ish for most of up to 2020, and then a big drop down to less than half that, and we seem to be making our way back up. Having said that, there's some, the most recent data seems to be turning down a bit. And so I've got another graph that sort of shows it month by month and breaks it up by the total. So for each year. So each year is a line on this graph. And the really dark one is the 2022 years. And then all the other lines are prior years. And so what we can see from that is that the most recent one, construction's running really hot, so much higher levels than it has at any stage in recent ones up until August. But then after, it seemed to have died pretty quickly for September and October, October's still preliminary data, but it's had a big drop off, and so it's gone from running well above to potentially coming back to within normal range. The total is certainly much higher than we had for the last 2 years, but it's at the bottom end of the range we've seen over the last 10 years, and so and fading down as well. And so there's some weird things going on. We spoke last week to some of the guys in the property industry, and they were talking about the ATO getting a lot more active, but that was only in its early stages, and that sort of you'd expect that data to be coming through, maybe over the next 6 months rather than sort of having already hit. And then we've also spoke as well about some of the laws have changed. And the only other thing I wanted to put in context as well, so that was business insolvencies. I've got another chart just showing personal insolvencies and how that's over a similar time frame, and that's just still at very low levels. That we've only got up to June data there, so that's not as up to date. But again, personal insolvencies are no sign of recovering. So anyway, with that in mind, I might throw over to you, Caroline, and get your thoughts on insolvencies and what you're seeing and hearing.
Sure. So you remember, I think the last time we had a chat, we still had the temporary insolvency measures in place, and that they made it a lot more difficult it provided protection, I suppose, for companies during the pandemic. So the thresholds to issue a statutory demand were a lot higher. We really saw business insolvencies drop right off. And I guess the entire industry at that time thought that when those measures came off, that there would be a spike in insolvencies. And we were all just kind of waiting to see what happened. And that spike in insolvencies never actually happened when those temporary measures came off. And now looking back on it, I think there is a few things which allowed that to stay subdued for such a long time. I think the first thing is that credit was still really cheap. Business credit was really cheap. And so you weren't, you had debt funding, you had businesses borrowing money, but because the cost of servicing that debt was so low, they were able to drag it out and carry on. The ATO, which does wind up a lot of companies who haven't paid their tax, they weren't winding up companies, and it's only just in the last couple of months that they've started to do that. But I think it'll take a little while for those figures to flow through. And I think from the creditor side, creditors just didn't have the appetite to wind up companies. Often creditors would wait for the ATO to essentially foot the bill for the winding up, and then they would just put in a proof of debt. But there were a lot of companies that were struggling for cash flow, and so they thought, well, look, if this creditor of mine or this debtor of mine doesn't have the money to pay, what's the point of incurring the cost in winding them up? But we did see one thing that I thought was really quite interesting, and there has been some research of this by Helen Anderson out of Melbourne University, but also there was an article in the Areta Journal talking about the huge increase we've seen in deregistrations. So liquidation and external administration is just one way of a company essentially, the end of a company life. But if you don't pay your ASIC fee, then the company ceases to exist after a period of time. And what this research has shown is that in 2016, there were about 32,000 companies which were deregistered, and that represented 5 times the number of liquidations, where in 2021, that number's gone up to 52,000 and represents 13 times the number of liquidations. Now, we do have to keep in mind that in 2021, we had less liquidations than normal, so that proportion isn't exactly perfect in the normal kind of circumstances, but you are seeing significantly more companies deregistered, and partially that is directors walking away, partially that is the ATO not winding up companies that they may otherwise wind up, and it just shows that where creditors don't have the appetite to wind that company up, and the directors walk away, then it just all disappears, and there's no reckoning in the more formal way that we generally talk about liquidations and other forms of external administration. So I thought that there was really interesting, and I actually wouldn't mind tracking deregistrations over the next few years to see, is this actually a trend or is this a COVID hangover?
Yeah, that's very interesting, actually. I'll add that to my suite of things to follow up on, because that's and so I mean, I guess just to put it in context, if I'm owed 5-10 grand by somebody, it's probably going to cost me that again to start court proceedings, I'm guessing. Is that right?
Yeah, so usually to issue something like a stat demand is pretty cheap. And normally that sort of thing is under the $2,000 mark. But if you want to actually do a winding up application, you're looking, depending on what it is and how complicated it is. I mean, you can burn $20,000 without trying too hard. So if you're going to take the step yourself to wind up a company, then you want to be sure that, well, one, there's a fair bit of money owing, and two, that you've got some chance of recovering some of that money. If you think that, well, that company owes me $100,000, but they don't have $2 to bless themselves with, well, then why would you go to all the trouble of winding them up when you're not actually going to get anything out of it in the end? And then it's $100,000 plus whatever your costs of enforcement are, and it's not really worth the exercise in the long run.
And as you said, that it's in the past, it's been the tax office who's basically on, well, they will chase them for the unpaid debts. So if the tax office, if the message sort of went around to them is like, okay, now's the time, we're going to start making phone calls and start collecting again, this financial year. So let's say 2 or 3 months ago, they've really actually started getting stuck into it. I'm guessing this is a relatively long process anyway before they'd get to the court. Like, are we talking 6 months, 9 months before they'd finally the wind up, or is something relatively, just in terms of when should we be expecting sort of the wave of ATO wind ups to start occurring?
There will be a bit of a lag, and I did listen to your podcast last week, and I thought that there were some really valid points made there. The ATO will first try and talk to whoever the business is, will try and set up a repayment agreement. They'll try and do all those things first. So it will only really be in the case of, directors or businesses which just fail to communicate with the ATO, where you will see those enforcement proceedings occur sooner. But for those who try and cooperate with the ATO, and it's the same with your bank. If your bank calls, pick up the phone. When a borrower goes AWOL, that's when banks start to get nervous. So if you keep talking with the people you owe money, then that formal enforcement type action will always be further down the track. But I think, to be honest, it's at least a 3 to 6 months exercise once you actually see it flowing through to the figures, because it takes an amount of time for just the process itself to be finalised in court before a liquidator is actually appointed. But I think you'll see the ATO give people a chance, but I'm actually thinking the next 12 to 18 months is where you're actually going to see not necessarily a spike, but a bit more of an uptick in this sort of thing once the ATO and businesses have tried to come to an arrangement. But there was some new insolvency data out on the ASIC website just on the 21st of November, actually. So it's really nice and fresh. We've obviously got the data from the previous year, but with the quick increase we've had in interest rates over the last few months, I'm not really quite sure whether that there is as relevant to what's happening right now. But if you look at
what do we have to look at? Yes. Okay. We'll assume she's come back on, but I think from the insolvency part as well, I guess the other thing's worth noting is as you're talking about, that there's a number of businesses that, not number of businesses, most small businesses are backed by houses. And so the lending process for the average small business is usually as simple as, have you got a house? Okay, can you take a mortgage over it? Great. Here's your $100,000, backed against the house.
The other thing that we need to be really clear about in the insolvency context is when we're talking about a company being insolvent or trading while insolvent, the relevant test is a cash flow test, not a balance sheet test. So even if you've got assets on your balance sheet, if they are not liquidated, and in other circumstances where you literally can't pay your debts as and when they fall due, then that's where you start to have insolvency issues, and they are the relevant insolvency issues. How much cash is coming in and how much cash is going out. So the ability to liquidate assets and the types of assets that are sitting on balance sheets, they are relevant to an extent, but the most relevant thing about them is how quickly they can be turned to cash.
But for a small, most small businesses, if I'm right, are basically lending against their own home anyway, and we have had some pretty reasonable house price appreciation over COVID, which sort of probably helped a lot of these stats as well. I'm assuming that would be treated as a relatively liquid asset in terms of, if I've paid my home down to 60% and I wanted to take it back up to 80 to pay the tax department, that would be a loan that would be relatively quick for a bank to process.
Those sorts of loans are generally relatively quick. What will be important for the bank in a credit assessment sense is, well, you can take it up to 80 now, but what is the value of that property going to be going forward? So house prices in WA, for example, they've come off a bit, but they've been relatively steady, as you guys have talked about before. After the mining construction boom.
Sorry, Caroline. Can we go back to that? We lost you just at we lost you just at the point, and I'm gonna run it all straight through the phone now.
Okay.
I lost you just at the point where you were saying about so we're talking about the pandemic and people had stopped going out and spending money at that point.
Yeah. Okay.
Sorry.
And because people had gone out and stopped spending money, they were online shopping. Principally, they were online shopping. They couldn't do all the things that they usually did with their discretionary spending. Plus, they were receiving JobKeeper, and for those people that their pay was unaffected during the pandemic, they still had that discretionary spending. So we saw a huge uptick in goods demand, massive amount. Uptick in goods demand, and I saw it within my own business. There were some weeks, so I sell but mainly luxury handbags, but I saw there were some weeks there during the early parts of the pandemic where you'd sell 25,000, 30,000 worth of luxury handbags in a week, and it was just people were just sitting at home with money and nothing to do, and so they were spending it on, in my case, luxury goods, and we saw that across the board. We saw that not just with handbags but with the luxury watches market. There were some people who were buying new, but the price particularly of secondhand luxury watches just went through the roof. And so that there was a really interesting and I suppose somewhat unexpected exercise that occurred, and that they're reflected in a lot of obviously the luxury goods groups, that their market prices, because I just don't think a lot of people expected that demand to be there. The other business that I run is a luxury goods authentication platform, and so we are used by retail buyers, but we're also used by resellers who get us to check that all their stock is authentic before they sell it. And so even in the last few months, the change has been really interesting to watch. So say, for example, 18 months ago, you would have certain types of handbag and even expensive handbags, 10 to 15,000, that they would come for sale and they'd be sold in 2 minutes. That became the norm. It was just unbelievable how much demand there was for those sorts of products, all the way down to even your lower value luxury goods, that 600 to 700 amount. So there was plenty of demand there. What we're now seeing is there is still that demand for that plus 10 to 15,000 bracket, but it's slower. Things aren't selling as quickly as they were. But that probably 1,500 to 600 bracket, the bottom has totally fallen out. So I think that there is really interesting, because if people are conscious of cost of living issues, if their mortgage has gone up, and they're already
saturated debt-wise, or they're already going through their savings. They just don't have that same discretionary spend. And I know there's talk that there's going to be less consumer spending up into Christmas, and I think people really have tightened their belt. The fact of the matter is, if 12 months ago you could afford without thinking to spend $15,000 on a handbag, well then probably now you can still spend $15,000 on a handbag without thinking. But if you are in that bracket where all of a sudden things are tightened up and you're sitting in that lower end of the market, you're either moving again into an even lower end, into that sub $600 market, which some people are, but they're having to downgrade what they really want. But there's other people who have just stopped spending. And there's a big chunk of that, well, I've just stopped spending, or if I can't have what I want, I'd rather not have anything. So it's been absolutely fascinating to see that total change in demand. I'm not a watches person per se, but I've got a lot of friends who are collectors, and they've all said that the watches market, the second-hand watches market, has probably come off between 15 and 20% this year. And all of a sudden, on that second-hand market, you're seeing price drops on pieces which, 12 months ago were snapped up, in a blink of an eye. So I think there's definitely a slowness to demand, but that higher end is holding up. And we will see that in things, for example, premium wine. That they're talking about the lower end of the wine market dropping off, but premium wine is remaining buoyant. So for those people who still have that disposable income at that higher level, they will still spend that money. But where they may necessarily used to have to make a little bit of a sacrifice, or something was a big purchase, they're now just not making that purchase. Incidentally, we are seeing resellers put authentication orders into our company, and sometimes they've got a client who's getting rid of 6 to 8 Chanels that are brand new. So you're talking about 60 to 80 grand worth of stock that's never been used. And all of a sudden you're seeing this very new stock all coming through onto the second-hand market, which people have bought, but now maybe they've maxed on their credit cards, or they may have big mortgages, and with the interest rates going up, that servicing of debt has increased substantially in an aggregate sense. And so you were also seeing those sorts of people who previously had spent like that now kind of paring back and getting rid of what they've got in their wardrobe and they're not really using.
Yeah, that's fascinating. And within that market then as well, so from talking to the companies, let's take watches as a good example. They spoke about just problems in terms of supply chains and stuff like that, and they weren't producing as many watches as they wanted to. And so I'm guessing that some of that demand in the secondhand market was sort of was leached off the, I can't buy a new watch, so I'll buy a secondhand one and bid up the price. And then and now that production's starting to come on, as far as I can tell. So I'm not sure whether that's. So I guess when you're saying a lot of this is falling away, are you talking about the whole market, or are you talking more the second-hand market you think is falling away, and maybe some of that's ending up in the new market and some of that's just disappearing?
Yeah, well, there is definitely was a buoyancy in the second-hand market because of supply issues. That goes without saying. And I really love the graph that Carrie Brooker does, showing the inventory on second-hand cars, because I feel like that there kind of goes for the handbag market as well. And there was a period of time where if you wanted something and you weren't able to get it, it would then be sourced on the second-hand market. And you could probably get it new or very close to new, very good condition, and sometimes you'd be paying over retail, but not always. The handbags are a little bit different to watches. Watches can be hugely over retail. You don't really see that so much in the handbag market unless you're talking about Hermes Birkin or an Hermes Kelly. They seem to be the only two bags which really go very high over retail. But the second-hand market definitely did soak up some of that demand because there were those supply issues. So some of that is definitely coming off. But equally, and I don't know what the proportion of it is yet, but there are certain people who would previously have bought something new, which they may not now be able to afford to buy it new, but they may be able to afford to buy it secondhand. So that there could also potentially be, counterbalancing, what may be holding up some of that secondhand market.
The Chinese buyers, so they're obviously still locked into pandemic lockdowns and reopenings and all that type of stuff. I'm assuming that the disappearance of the Chinese tourists from around the world has made a bit of a difference, but I don't know what your thoughts are there.
Yeah, there definitely has been, and but I think that there's broader across the Chinese middle class. So you'll see that with regards to luxury goods, you'll see that with regards to wine and Wagyu and all those things that the Chinese middle class got really used to, obviously, before we got whacked with a whole heap of trade sanctions. That market has definitely shrunk. Or not shrunk, but it's definitely dampened. And, I mean, you guys talk all the time about, the broader issues in the Chinese economy, broader issues in the Chinese property market. And so some of that is affecting demand. What has been really interesting is the way that some of those big luxury goods groups, which became really reliant on that Chinese demand, have managed to kind of redirection themselves back to the US and back to Europe and back to those other markets. They've had to pull back from the Chinese market simply because no one can get in there and no one can get out, as it turns out. So they have reorientated themselves really well, and while some of the groups, they've dropped off a little bit in demand, depending on the brand, most of them have actually held up pretty well, considering the change in Chinese demand.
And the other place for demand, and I don't know. I've got absolutely no idea how to measure this, but I can certainly measure it by anecdotes in terms of the crypto bros or whatever. In terms of crypto ran up to 60,000 or whatever, and if you looked at Instagram feeds, I think luxury goods and all that type of stuff that people were posting, just sold my Bitcoin and bought whatever. I'm assuming that's another place that's going to be dampening in terms of demand. But it's as I said, I've got no idea about the stats other than anecdotes.
Yeah, well, I'm in a similar position. There are definitely some brands of choice. So brands like Balenciaga, brands like Gucci, Off-White, Givenchy, they are very big with that crowd. What is interesting, though, is that those brands tend to sit within larger groups. So it's a bit difficult to work out what the actual reduction is, because it's not like those brands are standalone and you can see that in share prices, or they generally sit in those bigger groups. The other one that is interesting is the luxury goods brands that went into things like NFTs. And now that, they were super hyped for a while, and now, there's no interest really in luxury goods NFTs. So I think Gucci was one that went there, and Balenciaga was another. But those brands were definitely the brands of choice for that group, that cohort. And we definitely hear a lot less of that connection, or a lot less of that promotion and hype that there was, at least, 12 months ago and more.
So, okay. And so in terms of, if you were going to pick so there's obviously a number of big listed companies that we and lots of other people look at. It sounds as if from what you're saying is the exclusive end is probably still the place to be, rather than I guess if you start at the Hermes level, and that's sort of like very, very exclusive, and then as you work your way down through the brands, you get some brands that are sort of a bit more, I guess, the borderline. Yes, they're making more affordable products.
Yeah.
And so I guess what you're saying is, it sounds like the exclusive end is still the place to be.
Yeah, it really is. And if you look at if you look at each of those kind of groups over a period of time, at least that 3 years, all of them seem to peak and have their high point at the end of 2021, which I think is more broadly in line with the rest of the market. But some of those have come off a bit more sharply than others, and others have held up. So you've seen, say, Kering has come off a little bit more. That there has, and I did this last time, but it's quite relevant. That has brands like Balenciaga, Bottega Veneta, Gucci, Alexander McQueen, and Yves Saint Laurent. They've definitely come off a fair bit since their high. Moncler has come off a bit as well. But what I find really interesting about Moncler is they've now become a much broader offering than what they were 2, 3, and 4 years ago. So I'm really interested to see what they do going forward, because they're not just, puffer jackets anymore. They've definitely broadened their offering, and you can find them a lot more readily now, either in store or online on things like My Teresa and that sort of thing. So the ability to purchase Moncler has become a lot easier. I think LVMH is still the standout. They are slightly down from December 2021, but hardly at all. Like, there's been a bit of up and down movement, but they have held really well. And what I think is so great about LVMH is they have a very high level of luxury offering, but it's very broad. So you can buy a Louis Vuitton, you can buy a yacht, you can buy Tiffany & Co., you can buy Dom Perignon, you can buy Belvedere. So they've just got this really broad luxury offering that really hits at that top level. But it's like, not only is it the top level, but we've got everything for you. And so I think that they have done a really good job there in having a great breadth of offering, but they're always hitting the same market, and that market is still purchasing. They do have some kind of, I'll say lower level, but it's not lower level luxury goods, but it's more, say, within Louis Vuitton, you can still buy something at $1,000, right? I mean, you can also spend $50,000 if you want, but you still can buy something at $1,000. So there is still some lower level entry point into those brands, but they have this really brilliant offering that I think is so well supported, and that I think that's why they've continued to do really well, even though some of the others have come off. Similarly to your,
I'm glad. Well, actually, I'll pull you up quickly on that one. I'm glad you mentioned that, because that is one in our portfolio, and we did buy it at a cheaper levels so it fell a fair bit into June, and we managed to pick up some, and I think it's safe to say they're very much a manager of brands now, as opposed to, like, I guess what I'm saying is, if some of them, like Moncler, for example, as you said, really started with puffer jackets and not a lot else, and now they're trying to expand. Whereas I think LVMH has got a pretty long history of buying other quality, family owned luxury goods, and then integrating it into the system and selling it down the pipeline.
Yeah, they absolutely do, and because you have that mindset, that luxury mindset, that's what keeps the standard. Everything there is really good. It's really well managed, great customer service, and so you're quite right. It has become this great little home for all of these excellent brands, and some of them are a lot smaller than something like Louis Vuitton or Hennessy, but there is this understanding that the business is run a certain way, and while they do have the occasional hiccup, they're not there just totally driving at cost reduction, You know, they're not trying to, you know, take the edges off and make things cheap. Like, they understand that they have a clientele that expect a certain kind of product, and they put forward that product in such a way that, well, this is the price you paid for it, but this is the standard, and this is the quality that you get with it. And I think that makes a real difference compared to some, you know, more middle level brands, which are definitely more focused on keeping margins up and keeping costs down.
Excellent. And while we're talking, I'm just aware as well, we are running a little bit out of time. So there's a couple of things I just want to touch on as well. So secondhand market, you know, obviously there's, well, actually for anyone who doesn't closely follow the whole Kanye West episode. So basically, maybe I'll summarize it quickly, and then I'll let you say what you think in terms of what it's done to secondhand goods. So, you know, he basically a partnership with Adidas, selling shoes, which were effectively selling shoes as a luxury item, where they would not produce enough shoes to meet the demand, and then the shoes would then sell on the secondhand market at much higher levels, and then attract more interest. And so it's almost deliberately producing not enough in order to attract interest. And then he's blown up with a number of anti-Semitic problems and been kicked out of Adidas and trying to go elsewhere and hasn't been able to get into it. You know, I guess your thoughts on what that means for the secondhand market, whether there's any changes to the exclusivity thoughts, and I don't know. I guess it just seems like a relatively big change to that. Certainly the shoe side of that.
Yeah, it is, and I don't think it's really come out in the wash yet. I think this is going to be more of a middle term sort of thing. So when something has small production but constant production, that there really keeps the second-hand market buoyant. And Hermes is a great example of that. But once you stop producing something, after a while people forget about it and they move on to the next cool thing. And so what will be interesting to see is, do people just forget about Yeezys all of a sudden because they're no longer produced and someone else is producing some other newfangled cool luxury good that all the kids are wearing? Or does it become a bit of a collector's item? And I'm not sure what the answer to that is. We have seen other designers kind of fall foul of the PR issues like that. We saw Dolce & Gabbana fall out with the Chinese market for a short period of time over comments that were, or an ad that was considered to be a bit racist. And obviously John Galliano had to go and spend a little bit of time on the bench after some anti-Semitic comments which he made. But his business still continues. So it will be interesting to see how long the fallout is. But personally, I think, you know, unless there is some kind of effort that keeps Yeezy going as some kind of old school collector's item, I think if it is no longer produced, that everyone will eventually forget about it.
And I wonder as well, it's probably, for me, there's probably more risk if you're saying, I guess what I'm saying, if you're a luxury handbag maker and your founder is 80 years old and has made some unsavory comments, maybe a lot of your clientele is quite old as well and might not care as much. Whereas if you're a shoemaker and most of your clientele is in the 30 to 40 range, or the younger, I guess 20 to 40 year range, then maybe you actually there's potential for more backlash, I guess, in terms of people deciding not to buy as a I don't know, a
political point.
Political point, yeah, exactly.
Yeah, I think that's a really fair observation. Older people too don't tend to be boycotters, you know, or they can separate politics from or they're a bit more they're not that they don't care, but they tend to be a bit more sanguine about those sorts of things. The younger generation is definitely a bit more righteous about those sort of things, and, you know, they won't eat meat and, you know, they won't do certain things to make, from a political values point. So that's entirely possible, and that they are more likely to boycott. Yeah, so I think that's valid. But I think I don't think it's finished playing out yet. I think we can have this conversation in another 6 months' time or another 12 months' time, and I think a bit more would have gone through the wash.
Yeah. Yeah, no, it's well, as I said, I'm not a sneaker guy myself, but I know lots of them, and so I just don't know where that, maybe that just means that the old school Nikes go up more in value, but yeah, it's a tough one. The other one, actually, the other thought I had on this was the whole pandemic idea. Is, do you think the pandemic might have created more people who are interested in this part of the market? Like, it's hard to say. I sort of feel, on one hand, I go, well, I feel like there are a lot of people who had a bit of a a bit of a reflection on what they're doing and saying, no, you know what, I want to go to a less consumption, and I'll live in the country more, and I'll work less, and I'll, and maybe, I won't be buying those brands. But on the flip side, there's a lot more people left at home buying goods and cruising Instagram and spare time on their hands and nowhere to spend it. And so maybe they've now entered the luxury market, buyers who wouldn't have otherwise been that way. I don't know what your thoughts are on sort of the pros and cons from the pandemic.
Oh, look, it definitely, I guess anyone who likes this sort of stuff will tell you it's a slippery slope, right? And once you get a liking for this sort of stuff, it's very difficult to back out, right? It's, not that it becomes an addiction or anything like that, but once you get an appreciation for the finer things in life, you do get a little bit attached to them. I think there are some people who do have that kind of come to Jesus moment and realise, well, this is just stuff and it's not that important, and I'm going to go and instead of spending my money on luxury goods, I'm going to save it for holidays with my family, because that's the most important thing. Or we're going to do a road trip around the east coast of Australia or whatever. So I think that there is definitely some of that. And I also think now that people can travel, money that they may have previously spent on luxury goods during the pandemic, they will spend on other things like travel. But, there will always be that part of the luxury market where it's just the thing that people do. These are people that don't have to worry about paying their power bills, so it'll be business as usual. We definitely saw just such a profound change of behaviour, and I just thought it was fascinating to watch it right up close, Damien. It was fascinating to watch it right up close. But look, again, I would love to revisit this in 6 to 12 months' time to see if there is any sort of pandemic hangover, and how many people are selling, 20 pairs of $1,500 shoes that they bought where the soles are still squeaky clean that they've never worn.
Yeah, absolutely. No, definitely love to talk again. I've got to actually wind up, Sam. I don't know if but maybe.
Yeah, we'll just quickly do the question of the week. So this is for viewers to have some discussion in the comment section over the coming days. The question for this week is, which sector is the canary in the coal mine? So feel free to post your thoughts and engage with us.
For insolvencies, yeah, which sector should we be watching most closely?
Yes.
I think retail. I think retail is probably the one to watch going forward. I think it'll be really interesting to see if we get a few more interest rate rises, if people got a bit more pressure on mortgages, a bit more pressure on the inflation, grocery bills, all of that sort of thing. I think that there will really turn the tap on or turn the tap off, I suppose, on that discretionary spending. Things like rideshare, things like hospitality, things like retail. And the thing is, interest rates going up, it takes a while for them, firstly, to make their way into your mortgage payments. And then it takes a little bit longer until it starts affecting your behaviour, whether you've got a bit of savings to prop you up or whatever. It does take a little while to wash through the economy. So I think the retail sector, particularly that bricks and mortar retail sector, I think that there is a place to watch going forward. And on the construction front, I think there's probably still a bit more to play out there. We've definitely seen new home approvals drop in WA I'm not sure about the rest of the country, but what will be really interesting to see is going forward whether the construction sector and builders are still getting that cash flow coming into their businesses if you start to see a bit of a decrease in demand.
Absolutely. Now, Caroline, 30 seconds. Do you want to just let people know where they can find your stuff?
Okay, so if you want to find me, if you want a handbag authenticator, www.luxuryauthentication.com.au. If you would like to buy a handbag, www.thedailylux.com.au. I'm also on Twitter at Caro Di Russo.
Fantastic. Thanks a lot. Really appreciate you coming on again. And I'm going to have to cut here, but I will switch across to Sam.
Thank you.
Okay, thanks. We'll speak soon.
Thanks, guys. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to nucleuswealth.com/contact and you can book a call with myself. Don't forget to like the video now. And if you know of anyone that might get some value out of today's episode, would really appreciate it if you can please share it with them. If you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content or subscribe on our homepage for our weekly Nucleus news and investment insights. We do put out a lot of articles and videos in addition to this podcast, so you can check them out there. And of course, you can follow us on all social media. So for myself, Damien, Caroline, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.